everyone, and welcome to another deep dive. Today, we're going to be tackling a topic that's, near and dear to all of our hearts, our savings,
Mhm.
that money we work so hard for and hope will grow into something bigger, right?
Yeah. And with all the uh, recent economic ups and downs,
Yeah.
it's more important than ever to make sure your saving strategy is actually, well, saving you.
Exactly. We're diving into some research you sent over, and let me tell you, it's been eye-opening to say the least. It turns out that sticking with the traditional, quote, safe options, like a regular bank account, might not be so safe after all.
Yeah, that's right. This material points out something crucial.
Huh?
That cozy little bank account could actually be costing you money without you even realizing it.
Okay, so let's break this down. What exactly are these hidden costs lurking in our bank accounts?
Well, there are the obvious ones, right?
Right.
Monthly fees, service charges, all those pesky little deductions that, chip away at your balance.
Mm-hmm.
But the real silent killer is inflation.
Inflation. Ugh, that sneaky beast. It feels like we hear about it all the time, but it can be tough to grasp how it, actually impacts our money day to day, you know?
Right. It's not always obvious.
Right.
Think of it like this. Every year, the things you buy, groceries, gas, that new phone you've been eyeing,
Yeah.
generally get a little bit more expensive.
Mm-hmm.
But if your savings aren't growing at least at the same rate, you're actually losing purchasing power.
So even though the numbers in my account might stay the same,
Right.
my money is actually worth less over time because I can buy less with it.
Exactly.
Yeah.
And the source material highlights this with a really powerful example.
Okay.
Imagine you deposit $5,000 in a typical bank account.
Okay.
After just 1 year, factoring in, average inflation and those sneaky fees,
Yeah.
you could be left with something closer to $4,787.
Ouch. That's a real gut punch, especially if you thought you were doing everything right by, diligently saving.
Exactly. And here's where the source really throws us a curveball.
Hmm.
It issues a warning about blindly trusting financial advisors.
Oh, interesting. You'd think financial advisors would be the ones to, help us navigate these choppy waters.
You'd hope so, right?
Yeah.
But the source argues that even the, quote, experts might not always have your best interests at heart.
Hmm.
They might steer you towards products or investments that benefit them, not necessarily you.
It's like anything else. There are great advisors out there, but you have to be savvy and do your research.
Right.
Don't just assume someone has all the answers, especially when it comes to your hard-earned money.
Absolutely. This deep dive really emphasizes the need to be an active participant in your own financial well-being.
And speaking of being proactive, the source material takes a bit of a turn into, thriller territory
Yeah.
when it starts talking about what happens if a bank fails.
Oh, you...
Right.
Yeah.
You might think your money is, untouchable in a big established bank, but this source reminds us that those institutions aren't always as invincible as they seem.
Right.
It's like something out of the movies, right?
Yeah.
You deposit your life savings, thinking it's safe and sound, and then, bam, the bank goes belly up.
Exactly.
But what's the reality here? Is that something we really need to be worried about?
Well, it's not as dramatic as Hollywood might make it seem, but there are some important things to be aware of.
Okay.
The source points out that the way bank failures are handled has changed significantly, especially compared to a few decades ago.
So that safety net we thought we had might not be as secure as we once believed.
Exactly. One key point the source raises is the issue of state protection for depositors.
Okay.
You see, there's typically a limit, often around $100,000, on how much of your money is actually guaranteed if a bank goes under.
Wait, so if I have, say, $150,000 in a single bank account and that bank fails,
Yeah.
I could potentially lose a chunk of that money.
It's a possibility, which is why the source stresses the importance of diversification.
Okay.
It's all about not putting all your eggs in one basket, so to speak.
Right.
By spreading your savings across multiple institutions, ideally keeping your balances below that $100,000 threshold in each, you're minimizing your risk.
So even though it might feel like we're being, overly cautious, diversifying our savings is actually a smart move to protect ourselves?
Exactly. It's about being strategic and not relying solely on the perceived security of a single bank.
So we've talked about the hidden costs of traditional bank accounts and the importance of diversifying our savings.
Right.
But this deep dive takes us even further down the rabbit hole.
Oh, yeah, it does.
It gets into some unconventional tactics, some might even say tricks, for safeguarding your savings.
Yeah.
Okay, here's where it gets really interesting. Let's hear about these more, shall we say, creative approaches to protecting our cash.
Yeah, the source material dives into a few um, eyebrow-raising methods,
Okay.
some more practical than others.
Okay.
Have you ever heard of using cashier's checks as a way to, like, safeguard savings?
I've heard of them.
Yeah.
But honestly, I associate them more with those like send this amount to claim your prize scams
Right.
than with like sound financial strategy.
And the source acknowledges that
Yeah.
while cashier's checks offer a degree of anonymity and security,
Okay.
they also come with limitations.
Yeah.
They can be inconvenient for, large sums,
Yeah.
and there's always a risk of loss or theft, just like with regular cash.
Right.
Yeah.
Right. So maybe not the most practical solution for most people. What about the idea of foreign bank accounts? The source specifically mentions using PayPal as an example,
Right.
which feels strangely relatable in this context.
It's funny how quickly things change in the financial world, right?
It's know.
PayPal, once primarily known for online transactions, is now mentioned alongside like traditional banking strategies.
Right.
But the
Yes.
source emphasizes that opening foreign bank accounts, while potentially offering some tax advantages or asset protection, can also be a complex and potentially risky endeavor.
Okay.
You have to navigate different regulations, currency fluctuations, and potentially higher fees.
It sounds like a lot of hoops to jump through.
Yeah.
And maybe not worth the hassle for for the average person.
Exactly.
Yeah.
And then there's the classic safe deposit box.
Right?
Which feels very old school spy movie, right?
Little.
Yeah.
You picture someone sneaking into a vault with a tiny key and pulling out a stash of cash or diamonds.
Exactly.
But realistically, is a safe deposit box a viable option for protecting your savings today?
It's an interesting one.
Okay.
The source points out that safe deposit boxes offer a high level of physical security
Okay.
for things like important documents, jewelry, or even small amounts of cash.
Okay.
But they can also be costly,
Right.
and they don't offer any growth potential.
Yeah.
Your money just sits there, vulnerable to inflation.
It seems like all these creative methods have their downsides.
You do.
So what's the takeaway? Is it all doom and gloom for our savings?
Not at all.
Or bad?
The source material doesn't just leave us with warnings and cautionary tales.
Okay.
It also presents some proactive, potentially profitable options to consider.
Okay, I'm all ears. Let's shift gears from hiding our money to actually making it work for us.
Okay.
What does the source suggest?
Well, it starts with a slightly more active approach. Deposit accounts.
Okay.
We touched on them briefly earlier,
Right.
but remember how we discussed the impact of interest rate changes?
Right, those ups and downs can make a big difference in how much our savings actually grow. The source used the example of deposit accounts having really attractive yields in 2023, over 5%.
Yeah.
But with the current rates closer to 3%, it shows how quickly things can change.
And that's why staying informed is key.
Right.
It's not about predicting the future, but
Yeah.
understanding the current landscape and how those shifts might impact your savings.
So while deposit accounts might not be as, quote, safe as we once thought, they can still be a valuable tool if we're strategic and informed. What about other options, things that might offer a bit more growth potential?
This is where we dive into the world of bonds,
Okay.
specifically government bonds and Treasury bills.
Oh, bonds. They always seem kind of mysterious to me, like something only seasoned investors dabble in.
Right.
The source also mentioned something called BTPs, which I'll admit I had to look up.
Okay.
Turns out they're Italian government bonds.
Yes.
But in simple terms, what are bonds and how do they work?
You're right. Bonds often sound more complicated than they are.
Right.
Essentially, when you buy a bond, you're lending money to a government or an institution.
Okay.
In return, they promise to pay you back the original amount plus interest over a set period of time.
So it's like becoming a lender, but on a much larger scale.
Exactly.
Okay.
And bonds are often considered a, quote, safe investment
Mm-hmm.
because they're backed by governments or established institutions.
But, and there's always a but,
Right.
it's essential to remember that no investment is entirely risk-free.
Right. Even governments can face economic challenges. The source mentioned that countries like Romania and Italy have similar debt solvency scores, despite potentially being perceived differently in terms of overall economic stability.
Precisely. That's why it's crucial to do your research.
Mm.
Don't just assume that because something is labeled a government bond, it's automatically a guaranteed win.
It's like that common theme we've been seeing throughout this deep dive. Knowledge is power.
Right.
Don't just hand over your money and hope for the best. Ask questions, understand the risks, and make informed decisions.
Exactly. And speaking of informed decisions, are you ready to venture a bit further down the investment path?
Let's do it. The source mentioned something about ETFs,
Yes,
which sounds a bit more, shall we say, hands-on.
they are.
Okay.
But they can also be a great option for those who want to be more actively involved in their investments.
ETFs, or exchange-traded funds, are basically baskets of assets that you can buy and sell in the stock market, just like individual stocks.
Okay, that makes sense. But what's actually in these baskets?
It depends.
Okay.
ETFs can hold a variety of assets.
I see.
Stocks, bonds, even commodities like gold or oil. They're like diversified portfolios, all packaged up neatly in one investment vehicle.
That sounds pretty convenient. But with so many options, how do you know which ETFs are right for you?
That's where the research comes in, my friend.
Right.
It's crucial to understand the specific holdings of any ETF you're considering.
Right.
What types of the companies or assets does it invest in?
Right.
What are the fees associated with it?
Mm-hmm.
And how does it align with your overall investment goals and risk tolerance?
It's like anything else. Knowledge is power.
Yes,
The more you understand about ETFs, the better equipped you'll be to make informed decisions.
precisely. And that brings us to a crucial point the source highlights.
Yeah.
The difference between active and passive management in the ETF world.
Okay, let's break that down. What's the distinction?
Imagine you're choosing between two different restaurants.
Okay.
One has a fixed menu that's your passively managed ETF.
Okay.
It tracks a specific index, like the S&P 500, and its holdings don't change much.
Okay.
The other restaurant has a chef who creates a new menu every day based on the freshest ingredients and their own creative vision. That's your actively managed ETF.
Oh, okay. So with actively managed ETFs, you're relying on the expertise of a fund manager to make decisions on your behalf, choosing what they believe are the best investments at any given time.
Exactly. They're actively buying and selling assets within the ETF, aiming to outperform the market or a specific benchmark.
It sounds appealing.
It does.
Is there a catch?
No,
Is there?
active management usually comes with higher fees.
Okay.
You're paying for that expertise after all.
Makes sense.
And there's no guarantee that an actively managed ETF will actually perform better than a passively managed one.
So it's a trade-off between potentially higher returns and higher fees with no guaranteed outcome either way.
Exactly. And that's why choosing between active and passive management depends on your individual investment goals,
Right.
your risk tolerance,
Yeah.
and how involved you want to be in the process. Some people prefer the set it and forget it approach of passive management,
Right.
while others enjoy the potential for higher returns and the excitement of active management.
It's like choosing between a leisurely stroll in the park and an exhilarating roller coaster ride. Both can be fun. It just depends on your personality and what you're looking for.
I like that analogy.
Yeah.
And speaking of different approaches, this deep dive wouldn't be complete without mentioning a few things to steer clear of in the investment world.
Oh, the avoid at all costs list.
Yes.
I'm always up for a little financial cautionary tale.
Well, the source doesn't go into a ton of detail on these,
Okay.
but it does flag a few things to be wary of.
Okay.
And I think it's worth mentioning here.
All right. Lay it on us. What are some of the investment red flags we should be watching out for? Okay, spill the tea. What are these investment red flags we should be running from?
The source specifically advises caution when it comes to bond funds.
Okay.
Now, remember how we talked about individual bonds where you're lending money to a government or institution?
Right, right.
Well, bond funds pool money from many investors and invest in a collection of bonds.
So instead of holding a single bond, you have a little piece of many different bonds within the fund. Sounds like diversification, but applied to bonds.
Exactly. And while diversification can be a good thing, bond funds often come with higher fees than individual bonds.
Okay.
And because they hold a mix of bonds, their performance can be less predictable.
So you're taking on more complexity and potentially higher costs without necessarily getting better returns.
Right.
That makes sense. Let's move on to the next red flag.
Mm.
What about life insurance policies as investments? This one always makes me scratch my head.
I hear you. It's often touted as a way to, invest and protect your family at the same time.
Right.
But the source emphasizes that life insurance should primarily be seen as just that insurance. It's there to provide financial support to your loved ones in case of your death, not necessarily to build wealth.
So while some life insurance policies do have a cash value component that grows over time,
Right.
they're not usually the most efficient way to invest your money.
Exactly.
Yeah.
They often have high fees and limited investment options.
Okay.
Compared to other investment vehicles, their growth potential can be quite limited.
Got it. So it's important to separate the insurance aspect of life insurance from the investment aspect and not treat them as one and the same.
Right.
Makes sense. What about that last red flag? Certificates with protected capital, what are those?
These can sound very appealing, especially for risk-averse investors. Essentially, they promise a certain level of capital protection,
Okay.
meaning you won't lose your initial investment. But of course, there's a trade-off.
There's always a trade-off, right? What's the downside here?
Well, that capital protection usually comes at the expense of potential returns. Certificates with protected capital typically offer very modest returns, often barely keeping pace with inflation.
So while you might not lose money, you're also not likely to grow your savings significantly.
Right.
It's like that old saying, a penny saved is a penny earned. But in this case, it might not even be a full penny after inflation.
Exactly. The source material seems to be encouraging us to, look beyond those seemingly safe options and explore investments that offer a better balance of risk and potential reward.
It all circles back to that core theme we've been discussing throughout this deep dive. Being informed and engaged with our finances. It's not about blindly following someone else's advice. It's about understanding the options, weighing the risks and rewards, and making choices that align with our personal goals.
Couldn't agree more. This deep dive has really highlighted the importance of being proactive with our money, asking questions, and not being afraid to dig a little deeper to make sure our savings are actually working for us.
Absolutely. We covered a lot of ground today, from the potential pitfalls of traditional bank accounts to those uh, eyebrow-raising tricks for safeguarding our savings. We even ventured into the worlds of bonds and ETFs. It's been quite a journey.
It has. And I think one of the most valuable takeaways is that there's no one-size-fits-all answer when it comes to managing our money.
Right.
The best approach is the one that aligns with our individual goals, risk tolerance, and financial situation.
So true. And that's where the real work begins, right? Taking this knowledge we've gained and putting it into action. That might mean revisiting our current savings strategy, exploring new investment options, or simply becoming more informed about the financial products and services available to us.
Exactly. It's about empowering ourselves to make the best decisions for our financial well-being.
I love that sense of empowerment. And you know what else I appreciate about this deep dive?
What's that?
It doesn't just focus on the practical nuts and bolts of managing our money. It also prompts us to think about the deeper psychological and emotional factors that influence our financial decisions.
That's such an important point. We often overlook the role that our beliefs, attitudes, and even past experiences play in shaping our relationship with money.
It's like that saying, money is just a tool. It's how we use that tool and the meaning we attach to it that can make all the difference.
Absolutely. And understanding those deeper motivations can be incredibly valuable in helping us make more conscious and aligned financial choices.
So to our listeners out there, we encourage you to take some time to reflect, not just on the practical tips and strategies we discussed today,
Right.
but also on your own beliefs and attitudes towards money. What messages did you receive about money growing up?
Right.
How do those beliefs influence your financial decisions today?
Those are powerful questions. And remember, there's no right or wrong answer.
Right.
It's about becoming aware of those underlying influences so we can make choices from a place of knowledge and intention.
Beautifully said. And with that thought-provoking note, we're coming to the end of another deep dive. We hope you found this exploration of saving strategies and investment options both informative and empowering. Remember, knowledge is power, especially when it comes to your hard-earned money. So keep learning, keep asking questions, and keep diving deeper into the fascinating world of personal finance. Until next time, happy saving.